Look, the markets have recovered after the worst start to the year, but if you're paying a professional to manage your nest egg, you're probably not doing as well as you think or as well as you liked. Joining us now for the numbers and to explain why, Joe Fahmy, Managing Director at Zor Capital, along with Fox Business Senior Correspondent Charlie Gasparino. And first off, the numbers, Charlie, do not look good for the guys people pay a lot of money to.
No, I mean, I don't know how hedge funds justify 2 and 20. You pay 2 upfront as a management fee, 20% of 2%, 20% of any profit that comes out. And if when you're chairing the S&P or losing money, I don't know how you justify that. Joe's going to unpack this, but I will say this: it's not. These are the top money managers in the country who, and Joe will point this out, who are all down. I think there might be one that's up, and ironically, it's Steve Cohen. Right. He's only managing his own money. He got thrown. He can't
to that end, Joe, what's going on? And we need to pay people to lose our own money here?
Well, I think there's two reasons. Beneath the surface, the average stock is down a lot more than the index. So last year, for example, the market was flat, but beneath the surface, there were so many stocks in the S&P 500 that were negative. So we're right now about 6% off the highs, but the average stock in the S&P 500 is 19% off of its highs. So, and that's because it's market weighted, where if you weren't in last year, the Facebooks, the Home Depots, some of the 10 big cap stocks that were holding up the market, and you were in energy and commodity names, that's why a lot of people underperformed last year.
So, Joe, we basically have a bear market in reality. Is that what you're saying?
Well, beneath the surface, there's a lot of things going on. And what makes it even more difficult for money managers is that this year is a exact opposite of last year. So this year, while Netflix and Amazon and those stocks are down, what's up are the beaten down names, so that people who are chasing that performance are the beaten down commodity and energy names. Biotech's a perfect example. Was up 30% recently, and now it's 30% off of its highs, or 45% actually off its highs, and down 30% this year.
Do you understand how frustrating it is for people, Joe, to pay their money managers or even hedge fund or basic mutual funds a percentage, and they can't even get it right? So why not just simply be in an index fund, which is something Warren Buffett has always argued?
I agree. For the average investor, if the stats are 88% of mutual funds can't beat their benchmarks, then you're better off just being in the index. So if you can't beat the S&P, just be in the S&P. You get 500, plenty international, diversified companies, and you're better off being in the index where it's low cost for the average investor. So there are some people who are looking for, high net worths and so forth, institutions that are looking for hedged products. So they actually shouldn't be compared to the S&P because they're not fully invested 100% of the time.
As you know, these average people have been dipping has been slowly going into hedge funds. I mean, when we talk average people, beyond institutions, I mean, we're talking about modestly rich people, not the super rich, who have been going into these hedge funds more and more because they think these guys have the magic bullet. And obviously, Bill Ackman, what is he, down 20% this year?
Yeah, I mean, those are people are concentrated, and you should know when you're getting into something like that. They're concentrated portfolios, and some people actually want some short exposure, but the markets, we haven't really seen any nasty corrections until this year, but even this year, everything seems to come, in the last 5 years, anytime we've had a dip, it's snapped back so quickly that those managers have difficult time outperforming because the market doesn't stay down.
Is Ackman and the Peltzes, I mean, they're probably, maybe I shouldn't use them because they're bad examples. Peltz is an activist investor, so he takes concentrated plays. So does Ackman. But generally, those money managers, are they doing a rotation? Are they trying to catch up to the market?
No, I think for those guys, in their defense, they're in it for the long run. So a lot of those guys have phenomenal track records over the long term.
Well, a perfect example there is Valiant. That's where Mr. Ackman had lost a lot of money, but he believes that in the long run, he will come out a winner. But for our retail viewer investor audience and the CEOs who are watching us right now, they're looking at these numbers and they're saying these guys can't even perform as well as a basic S&P. It's really annoying for some people out there.
Yeah, and I agree. And that's why from your average person who's in their 401k, when you have a choice of 10 or 12 mutual funds, you're better off putting the entire thing in the S&P 500. Because if 9 of those 10 mutual funds can't beat the average, then you might as well just be in the average. But for people who want a little bit of hedge exposure or maybe believe in a manager and want some concentration, then by all means you could go with one of those managers, but you have to be with them for a long time. Even David Tepper had 30% declines in the last 15 years, but he's one of the best out there if you were patient with him.
Joe Fahmy, Charlie Gasparino, great to have the insight. Thank you so much.